All right, we're live. Hello, everybody. It is Wednesday night, roughly 9:30. We're here to talk to you about stocks that are poised to run post COVID-19. Actually, they're starting to get some footing right now, but we're going to dive deep into it. And today, we're going to do something a little different. We're actually going to present 14 stocks that are poised to run that you'll get to see live today. That's a little different than our normal style. And Leon and I will still pick the one stock of his and one stock of mine at the end of our live today. So I'm going to ask everybody if you can just share this real quick, send it to a group, send it to a friend, and Leon, you can jump into it so we can figure out what stocks really are poised to run post COVID-19.
All right, so we're going to cover, as Brent said, stocks that are either benefiting now or benefit in the future from this pandemic. So I got this idea. I was watching Kramer. I don't know if any of y'all watch Kramer on CNBC. His show Mad Money. It's actually pretty good. You get a lot of good ideas from him. A lot of people like to dog him, but he's actually pretty good. Ran a successful hedge fund for a number of years. So what he actually did. So when this whole thing broke out, we really got hit in March. I think it was April. He actually created something called the Kramer COVID-19 Index. And the reason he did that was because he noticed, we all felt it. The market absolutely plummeted, right? But he made a good point. He was saying that, the S&P 500, which is considered the market, is made up of a lot of the brand names that we know. A lot of the Home Depots, the Apples, the Walmarts, names like that. A lot of these got hit hard because, again, no one saw this coming. But what he realized was that a lot of the stocks that were going to benefit from this actually were not in the S&P 500 because a lot of them aren't the biggest, aren't the baddest, aren't the biggest names. A lot of them that are going to poised to do well now. A lot of biotechs, a lot of consumer-driven companies that aren't the big brand names. So he created this whole thing called the Kramer COVID-19 Index, and over the first month, it outperformed the S&P. I think about 5%. So his thesis was right that the S&P was going to underperform because of the companies that it was made up of were going to take a huge hit because, again, nobody saw this coming. And things like Zoom, things like Etsy, a lot of these different names that aren't really, well, Zoom is now, but aren't really household names and aren't part of the S&P 500, we're going to take off and do well, and they actually did. So I got the idea. I was like, that's a good topic. Let me do some research on companies that I can find, Brent and I can find, that we can then present to you all that can actually be some good plays going forward in this whole COVID mess we're going through right now. Some of these are doing well now, and some of these will more do well in the future.
Yeah,
so Brent, if you can throw that slide. Go ahead. Yeah, take over. But you throw that slide.
Yep. So before I jump into the slide, think about this too. A lot of these companies, are you going to realize that they were already starting to build momentum? I've looked at just a few charts. Leon did this research, and him and I have been talking about it, but I haven't looked at all the charts. But some of these companies aren't as if they just came out of the ground and now they're growing. I want that to be clear. You're going to realize, you're going to know some of the names you won't. This is why you watch us, because we're bringing you information normally you probably wouldn't have access to, or you wouldn't think to research. So this is the time right before we bring up the slide to share this, call a friend. If you have a question, please put it into the comments. If you keep seeing me looking to the side, I'm checking comments while Leon's going through the next slide.
All right, so on this slide, okay, so here it is.
The branding.
Say what?
Notice the branding.
Right. We get a little better. We're stepping our game up a little bit. So yeah, okay. So what this shows, so there's seven different industries with 2 stocks each, right? So what this shows is actually that there's a lot of breadth as far as industries that we were able to find. Again, there are 29 stocks. Here there's seven sectors with 2 each, which brings about 14 stocks. But we found 29 in total. This is just a sample. So I'm going to start on the far left, which is gaming, right? So everyone knows gaming. You may have kids that do it. You may do it. You may have friends that do it. But gaming is huge, and it's gotten even larger under this whole pandemic because everyone's home. A lot of people are home. Kids are home. And then think about the future is that. So I know a lot of people know, but Twitter, Google, and Facebook are the 3 big tech companies that have come out and said either one, employees can work from home indefinitely.
Yeah.
Or you heard that too, right, Brent?
Yeah.
Right. Or two, that they'll be able to work from home either staggered or kind of on their own time. So working from home in the future is going to be like, I saw a thing today with Mark Zuckerberg. He's actually doing an interview, I think tomorrow on one of the morning shows. But they're really, so the reason they're really doing it is because they're saying in Silicon Valley, they can't find enough talent to fill the roles, right? Because they're just in Silicon Valley. So one, can't find enough talent. And two, they can't find a diverse population to fill those roles, right? So again, think minorities and women. Typically it's just typically, the white males that they're finding in Silicon Valley. And, that's really limiting their scope of talent. So they're looking, but what they realize in this pandemic is that, okay, our employees who are working from home, we've seen really no drop off in production. And so what they realized that one, production hasn't dropped with work from home. And two, they can cut a huge cost by having people work from home and then closing a lot of offices. So, so the companies on this list are going to benefit from that work from home. And one, again, is the gaming. So the first one is Activision Blizzard. Second one is Electronic Arts.
Let me jump in. Google announced, I think that one of their locations is a 400 plus location, and that they were shutting the doors to it. So anybody familiar with how these things work is business overhead expenses. It's called BOE for companies. And when you have BOE on your books, it includes lights, cups, paper towels, every soap,
internet.
That they pay for to have these offices up and running. They now cut these costs. These costs can be absorbing up to 30% of their overall expenses. So you think about a company and you think about why some of these stocks are doing extremely well in this condition. It goes back to Leon and I's, I think it might have been our second discussion, right? Where we were explaining to him how business overhead is actually increasing profitability, where it's not so much that all of a sudden it's new business coming in, it's a reduction in expenses, which is why some of these stocks had booms. And so we were explaining to you all, when you eliminate these expenses, the overall bottom line goes up. In addition to the fact that in some cases, they're seeing an increase in productivity. And, aside from the stresses that are out in the world, there's a recent company, and I'm just going to touch on this and I'm going to stop. But it was a drug company, 900 employees internationally. 880 are now working remotely, and they're realizing they never needed them in the office. That's a huge number, but go ahead.
Yeah, no, that's huge. And that shows how this whole work from home thing is going to drastically change hiring and employment, which is huge. One other point on that, Google just announced that they're going to reimburse their employees who are working from home $1,000 each. Because think about it. Google has, I actually don't know how many they have, but they have thousands of employees. So $1,000, but Google makes, I think Google's revenue last year was like $130 billion. So this $1,000 drop in the bucket to them is a drop in the bucket. Like they're not even going to see this, but what they are eliminating are those, like as Brent said, that BOE, business overhead costs, or BOE expenses of lights, electricity, internet, rental space, everything. A lot of that's gonna go away. So them giving this $1,000 to the employees is no big deal to them at all. But again, just showing how they're willing to say, okay, we'll cut some costs, we'll incur a few costs, but it'd be nothing compared to what we're going to cut. As far as
114,000 employees.
Google?
Yeah.
Okay. Damn. Okay. So if you say $1,000 times that's, my math is terrible. What is that? Well, I'm not gonna try to do that, but it's a lot of money.
I think it's 1,140,000.
Okay. Yeah.
Which they would never process. It wouldn't even.
Yeah. Like again, the revenue was 130 billion, 100 and some odd. Yeah, they're never gonna see it, so it's no big deal to them. So back to the list. So the reason gaming is gonna do well, as we all know, everyone's home.
No, hold on. I gotta correct myself. That's 114 million. I just never thought about that because you just add 3 zeros to the back.
Okay.
Yeah, so that's 114 million. They still not. That still doesn't matter.
Remember, but it's a one-time cost.
Yes,
so and then they're done. But also remember, it's not every employee. It's only employees that are going to be working from home. So it's only going to be a percentage of the employees. Not every employee, because like they're opening their offices back up next month. I think June 6th. So some employees are coming back, but a lot will stay home. So it's going to be again a drop in the bucket to them. Nothing major at all. It's only going to be a percentage of the employees. Not every employee. So yeah, back to the list. So gaming, as we all know why, because people are going to be home, workers are going to be home, their kids are going to be home because schools are out. Schools may not open back up. Active Blizzard and Electronic Arts have seen a huge jump already. and into the future, that'll most likely continue. These are both two solid companies that had strong sales and earnings anyway. So this is something that's just going to help them out even more. Next is retail shopping. Walmart. I mean, it's Walmart. You know, one thing about Walmart though is in this pandemic, so Walmart was getting their lunch eaten by Amazon on the e-commerce side. You know, Amazon's still number one. We all go to them first.
Yeah.
Walmart was starting to catch up to them a little bit. They were starting to make incremental changes that were catching up to Amazon. Since this pandemic, they've had to supercharge that effort on the e-commerce side. So analysts are saying in the next maybe 2 to 3 years, Walmart may catch up to Amazon as far as volume and as far as sales. So it's a huge. So this whole work from home thing, this whole pandemic thing, has actually brought revenue forward to Amazon to Walmart that they may not have seen for like 2 to 3 years. So Walmart's benefiting huge from this and will in the future. Another one is Hormel. Only thing I know about, I remember Hormel's. I think they made chili, but you know, people, you remember that, right?
Yeah.
People are hoarding food. They make a lot of other products. Again, do your research and see, but they make a lot of other products too. One good thing about them is that they pay a 2% dividend, which again, a dividend is that money you're going to make every year, no matter what the stock does. It's like an interest rate you'll make on the stock. Next was Enterprise Tech. Enterprise Tech is huge in this area. Enterprise Tech was actually the largest sector with the most companies in it. So two of the top ones here were Citrix. They're an enterprise software company. Then Datadog. I don't know if a lot of you have heard of them, but they're a cloud security and software company to enterprises. Next is technology and government REITs. This one is interesting. So the first one is called Easterly Government Properties. So right now, REITs, which are real estate investment trusts, are having a lot of problems. So what REITs do is they buy properties and then rent them out to businesses, right? Well, right now, as we just said, with the stay-at-home thing now, a lot of those REITs that had tenants of these big companies are going to lose a lot of tenants because a lot of those employees can be working from home. Interesting about Easterly Government Properties is they don't play in the commercial real estate game. They play in the government game, specifically the federal government. So again, they buy real estate and then rent it out to the government. This whole COVID thing has not stopped government. It won't stop government. If anything, this has actually increased government's output for all the services they're giving us now because of this whole situation. So Easterly is a really interesting REIT that I didn't even know about until I did this research. And they pay a 4.15% dividend yield, which again, your bank account right now is paying you 0.0001% per year. This is going to pay you 4.15% no matter what the market does.
Real quick, for the dividend, don't forget, people, the dividend changes every year. It resets to what the new dividend yield is going to be. It normally stays within it like close. It doesn't move too far from a variant of like 1 either way, maybe 2 on either side. But when you're looking at dividends, especially those of you all who are like, oh, I'm a long-term investor, I don't really want to do a dividend play. You got to think about what your portfolio looks like. And dividend producing stock should have some allocation inside of your portfolio. And it doesn't need to be everything, but it should have some allocation. And with REITs, you just want to check on them, especially right now, because depending on the REITs and how they're acquiring their property, sometimes the lease on the property versus some REITs actually buy and own. So just pay attention to your REITs.
Right. Yeah, good point. So the next one is Digital Realty. So what they do, so the reason why their business is booming now and probably will in the future is because, again, all these tech companies that are just killing it right now because everyone's doing everything online. So what they do is they actually buy up, or as Brent said, they lease data centers. So data centers are these big buildings that are like size of football fields that companies like Google, Apple, Amazon place their servers in. And so this company, they actually lease those, and they actually buy or lease those, and then in turn sublease those out to big companies. So as we're doing everything online now, and as work from home takes off, there's going to be a lot more capacity needed for their services. And again, digital realty service products and services are going to be in demand by these big companies. Next on the list was consumer focused. So here we had Clorox. Everyone knows what Clorox does. I mean, we knew about Clorox before this. And if you look at a chart of Clorox, like,
oh, it's crazy.
It's like through the roof. I mean, Clorox was a bit of a sleeper before this. Man, the thing is at all-time highs now. It's been ridiculous, and it pays a 2.23% dividend yield. So I'll put on dividends. So for me, this is my experience talking, the way I do it is, so inflation every year is roughly 2%, right? So I don't, and you'll notice every dividend that I have listed on here is 2% or more. Some of these companies actually pay dividends less than 2%, but for me, a dividend yield doesn't become at all exciting until it's at least 2%, because I want the dividend to at least match inflation, right? So, so if you're ever this is just the way I do it, do your research, but I don't see to me, it doesn't make sense to take on a dividend yield that's not going to actually make me money. It's still going to be losing money relative to inflation. So I look for dividend yields that are 2% or more, depending on the company.
And when we're talking about being higher than inflation, the importance is your money is eroding when you have it in investments that are less than that. So for all you all who are watching this, especially our people who watch these and they're sharing it with their family, you're sharing it with your friends, I appreciate it. I see the numbers clicking up. But the important part right now that we want to say is, what is your bank account giving you in your APR right now, if any at all? So when you talk about your dividend, you don't want it to be producing less than what inflation is, because technically you're eroding your money. If you're in a bank account, like a savings account, and that's where you save your money, you're not even saving your money. You're
not saving, right? You're literally losing money every day by having the money sitting solely in a savings account.
Yeah, don't do
it. Well, I mean, we all need checking accounts, but a savings account, again, inflation is literally 2 to 3% a year. If your savings account is only giving you 0.0002%, you're literally losing money every day. So again, we're not financial advisors. We're just putting the information out there that you may want to try to find. You may want to try to find another avenue for that money. If it's not stocks, look for a CD. Look for something else. But savings accounts.
Let's spend a little bit of time on this. We're still gonna stay within our time frame, Lee, I promise. But I got to spend some time on this. When you all get your money, you can either employ your money or you can fire it or put it on vacation. And what I mean by that is, when you get $1, it's the equivalent to getting an employee. Every dollar you get is equivalent to getting an employee. You can put it to work, like you want your employees to work. You can put it on vacation, i.e. put into an account this just matching or barely below inflation, or you can fire it, which is just blowing your money on things you don't need. If you think about running a business the way you manage your money, how well would your business do? Like, do you hire employees and then just give them a vacation? No, you don't do that. Would you just hire employees and then just fire them after you hire them for no reason? Right. No, you wouldn't do that. So why are you doing it with your money? Make sure your money is working. And we love the market, and we're proponents of the market, which is why we created IEA. And we also want you all to understand there's some basic budgeting that needs to be done in that space to help you understand what kind of money, Leon?
Risk capital.
There you go. Where your risk capital lies, and that's going to lie inside of your discretionary funds. So we're actually going to start offering some courses on understanding basic budgeting, so you can get to a place where you understand where your
risk capital
is. So, all right, I had to get on the soapbox.
Nah, that inflation thing bothers me too with the bank account.
It eats me, man.
I mean, you're literally losing money every day by having you just sitting in your bank account. Okay, back to the list. So under consumer focus, Clorox, we all know it. 2.23% dividend yield is great, beating inflation just by a little bit, but it's better than losing. So Etsy, a lot of people may or may not know Etsy. So Etsy is a marketplace. It's kind of like a scaled down eBay, right? So it's where people sell. So basically, instead of selling like commercial goods, like goods made by companies, is where individuals go to. They may make like toys, games, trinkets, things they make in their home, and they sell on Etsy.
Like home goods.
Huh?
It's home goods. It's where the mom and pop shops live for in lieu of like an Amazon or a big box.
Right, exactly. Yep, yeah. And they're I mean, they've been killing it since they came public. A lot of, like Brent said, a lot of small mom and pops who get kind of buried on Amazon go to Etsy, because they can actually be seen, because there's not, it's not as big of a following as there is on Amazon.
And people with Etsy, the Etsy move right now is this. You have all these people who've been affected by the pandemic. We're talking 30 million people who are on unemployment.
38 to be exact.
It's 38?
38 million, yep, unemployed.
38 million people on unemployment right now who are trying to figure out what their next play is going to be in the world. They're trying to figure out what their next business is going to be. They're trying to figure out just how do I move through this time and space and survive? Etsy is like the best platform ever because there are a lot of mom and pop shops that are very unique. And although Etsy is starting to become a little commercialized, like some of the resellers who used to live on Amazon doing FBAs or fulfilled by Amazon stores are moving to Etsy because they're realizing that if they can scale versus these people who are hand stitching or hand creating things, they'll win. But Etsy as a platform now is very attractive, very, very, very attractive because it's a more of a level playing field. And people are coming there because they have a favorite knitter who they just always go and buy their things, and they can't get it anywhere but Etsy. So Etsy has a very niche space in the market segment, and I think people should pay attention to Etsy.
Yep. Yeah, Etsy's relatively new. I think they came public, I don't know, 2-3 years ago.
Like 2 years. I think it's 2.
Yeah, like 2 years. But they've been killing it. The stock has been on fire since they came out. So next category industry is fast food. We all know Domino's. Domino's again has been absolutely killing it. They were doing well before this, and they're doing even better now. We all know their model: either go pick it up or delivery. When we were kind of more in quarantine before the opening, it was mostly delivery. So their business actually never even ceased. They just kept doing what they were doing. Companies like McDonald's, and we did a live on this a few weeks ago, and I had a post about this. But fast food really wasn't really affected by this. And the reason being is that a lot of people don't know, a lot of these big fast food like McDonald's, Wendy's, Chick-fil-A, who's not public, 70% of their revenues come from the drive-through window. And during this pandemic, their restaurant eating area has been closed, but their drive-through has been open. So they really haven't even seen a drop off. If anything, it's increased because a lot of people have said, they can't, everyone's home. So you're home all day. So the kids are getting antsy. You're getting antsy. A lot of people just go drive to a drive-through, one, to get food, and two, to get out the house. So they've seen, a huge increase in their revenue, and will probably remain going forward just by the whole the situation we're in. But again, fast food, their businesses weren't really hit that bad because they get 70% of their revenue from drive-through anyway. So when their main store closed, their drive-through never shut down. So they've just been killing it through this whole pandemic. Last one is healthcare. So this is another one that's interesting. So a lot of people have been, so healthcare also is covered by biotech, right? So a lot of people have been jumping on a lot of these kind of these new age biotechs. A big one is some of y'all may have heard called Moderna. And Moderna is going through a little trouble right now because it might be a little fraud. Because so they're one of the companies right now that are working on a COVID vaccine. And I think it was last week, right before, so they did a secondary offering, I think a week ago, and they priced it at 70 some odd bucks. But the day before the offering, they came out and said how great their trials were going in with their vaccine, and not just their stock, the stock market took off that day. I think went like 5% on that news alone. And then the next day, this offering sold the stock for $70 some. Well, now the SEC is looking at that because what everybody realized, they didn't put out any data behind it. They just came out and said, hey, great. And when we looked at the data, the trial, I think, only had like 200 or less than 200 people, which is not even really statistically significant in the United States of a country with 300 million people. So they're and in fact, they sold stock behind that news. So the reason I listed Pfizer, well, there's more, but the reason I picked these two, Pfizer, more to show, is because the way I'm playing this whole COVID thing, I'm not chasing these new age biotechs. Pfizer and Merck are also in the vaccine game for COVID, right? But these are companies that aren't relying on the vaccine as a main revenue source. A lot of companies like Moderna, even Gilead is another one. Gilead is a little more established, but they still have a lot riding on the vaccine for COVID. Merck and Pfizer aren't. They can care less. They're going to be fine. Once they get their vaccine out and they start selling it, they'll make more money. But they've been around for 100 years. They'll be around 100 years from now. But these are good, solid plays in the vaccine world because, again, they're both working on COVID vaccines. And Pfizer pays a 4.06% dividend, and Merck pays 3.15% dividend. So you can play the COVID vaccine. You can also have a solid biotech that's going to also pay you a solid monthly or yearly dividend.
And when you talk about Moderna, for those of you all who aren't familiar with how the market works, when stocks list themselves or make the announcement they're going public and they're in the process of going public, they're supposed to have what's called a quiet period. And during the quiet period, they're not supposed to release certain information or talk to the public. So when they release this information and then follow it up with the offering, it's actually this kind of price manipulation or market manipulation, and it violates the quiet period regulation. So that's regulation. That's a violation right there. Now, even looking away from that, it also starts to tell you about the integrity of the company. And if you're going to lie to the general public, they're definitely going to lie quietly to shareholders. And I'm not saying they are. This is all if it comes out that way, but that is a violation of a quiet period. But as you talk about, even with the real estate investment trust, and on this chart, Leon has the tech sector with the government real estate investment trust, and then the healthcare. This is my take. If I had to choose between those two sectors of where to derive my dividend from, I would choose healthcare. And I would choose the healthcare sector of organizations that don't care about COVID. I think Leon was spot on. So anybody who heard him just say what he said, I agree. I agree wholeheartedly. And anybody that missed it, just now is watching this, you need to go back and just hear that last piece Leon did, because it's poignant from a standpoint of so many of us right now. Even the title of today's topic is stocks that can benefit from COVID-19. But what you're hearing is a experienced investor talking about they're gonna benefit not because of the vaccines that they're going after as it just relates to COVID. They're going to benefit because no matter who comes out with the vaccine, they're going to get a piece of it. Like, they're too big not to be included. They'll either reproduce the drug, create a generic version of it. They're going to be involved. So whoever the front runner is, they just wait for it. And truthfully, depending on how small or big the company is, they can just acquire them. So, these are types of engagements you're not going to get on other platforms. And I'm saying this as a fan of Leon's. I'm not even saying it because it's us, it's our company. That was a great point. That was like borderline genius. I don't even think it was quiet, but it was, because so many people are going to chase that front running horse, and they're going to lose. And even when you look at government real estate investment trust versus a healthcare provider, the dividends aren't that different. So if I am going to choose, I'm going to choose a blue chip company that is going to be here because we're going to have health issues. But the real estate, even with the government being stable, we still don't know if the government will start divesting in the market once their contracts are up, because the government still has those properties contracted to these individuals. And when the contracts are up, although they may be leasing to the government and they think this is great, we don't know what business is going to look like 5 years when also 5G hits. So if you guys really have been following us since the beginning, you'll start noticing these trend lines. When you start looking at McDonald's and all this, we were talking about drive-throughs being 75% of revenue like 3 weeks ago. And these companies are resurfacing. When we talked about companies that were poised in discussion, we talked about Clorox about 4 or 5 weeks ago. And Johnson, it was along with Johnson and Johnson, and I forget the other one.
Yeah, so do I. But yeah, I remember that.
So but it was on our platform. So if you're not a member of the Investing Education Academy Facebook group, and I see the numbers ticking up right now, you should. Brent says, okay. So immunotherapy. I'm not even sure specifically. Pierre, if you want to give us a little bit of background on what you mean when you say that, we will touch on it. If not, post it in the Investing Education Academy Facebook group, and we'll dive into that comment, because we do.
What's the comment?
Immunotherapy specifically. That's all it says.
Oh, okay.
And so I don't know exactly what it means, but I'm happy to touch on it. And we've had some of our members enjoy the platform so much. Jamia specifically, she recently invited over 50 plus people to our group in the last 3 weeks. And you don't really have that happen unless you're doing something right. Leon and I, for everybody's watching, today we actually filed to make Investing Education Academy a company. And so we're excited about that. So we'll mark down our anniversary is like as soon as we get that in our EIN number for EIA, we are off and running. And we are about 80% done with our membership platform. And when we release the membership platform, I'm telling you all this information where we stop at 14, inside the platform, we're going all 29. And there'll be levels to it. We're going to welcome you to see it. We have an app, and the app will be downloadable to keep not only all of you all in touch with what we're doing as we pick stocks and talk about other investments, but you all will now be able to talk. So our members will be able to talk to one another, which we're really excited about. In addition to Leon and I being able to engage via chat features directly to individuals on our platform. Yeah, it's about to get real. And you want to tell them about the private equity plays that we have, Lee?
Yeah. So another thing we're doing that Brent and I've been working on is, so what we're going to do inside the membership is that we're going to, so right now, I mean, everybody knows we love the stock market. We live and breathe this. But for people that don't know, so I know everybody has, but there's something called venture capital out there, right? And a lot of people probably heard of that. It's basically where the wealthy individuals and wealthy firms invest in companies before they go public, right? Well, it was like, I don't know, 2 or 3 years ago, there's something called the Jobs Act, and I can't remember what it stands for, JOBS. And so prior to the Jobs Act, the only people that could invest in private companies and private equity deals were accredited investors. What that means is, I believe you had to have $250,000 in annual income and or be worth over $1 or $2 million in net worth. That was accredited. So the Jobs Act, but everyone was saying, well, so what would happen is, like the Airbnbs, or not Airbnb, let's say like the Etsy's, the Apples, the Googles, all that, before they went public, all these rich people, these accredited investors could get into it, they become public, and then we can get in when it was public. But these rich people were getting in at the stock was like 50 cents, 30 cents.
Let me jump in. And let me define what he means when he says accredited. I'll give you like the framework. It's 500,000 investable assets, been in the market over 5 years or more, and I think have a net worth of over $3 million.
Yeah, okay.
So that was the definition. He's like, these rich people.
Well, I mean, yeah, you had to be a multi-millionaire, which was unfair. Like we couldn't do it. So the Jobs Act opened it up to everybody now, right? So you, Brent, me, everybody out there can now invest in these early stage companies. So there are a lot of platforms out there on the web now that allow you to do some research into these things and actually look up some of these companies. But again, that takes research and time. So what Brent and I have done, what we're doing is we're actually going to aggregate a lot of these different sites underneath IAA, and then we're going to do all the due diligence and the research for IAA members, and then present these private equity deals to our members. So there's a chance we could hit on an Airbnb, or a chance we could hit on the next Apple, or who knows? It's all a gamble, but we're offering that service up as well. Not only public companies, but soon private companies that are maybe a year, 2, 3 years out from going public. And just to tell you, early investors get the stock at ridiculous prices, like literally 20, 30, 40, 70 cents. They'll get it at.
Oh, well, tell them about us.
Yeah. So we Brent and I invested in a company called Popcom. They raised over $1 million about a month ago. Brent and I.
First round.
Say again?
First round was over $1 million. Second round was over 1.1 million.
Right. And Brent and I via IA invested in the second round. Again, the same thing that we're going to be presenting to IA members. We did our due diligence, looked it up, liked it, and we put some money into it. So the private equity side is something else that we're going to offer soon too, because again, it's out there. A lot of people don't know about it. A lot of people don't really have the time to do the research that Brent and I are going to do, and then we're going to present that to IA members as well. So stocks, public market, and as well as the private market, we're going to be offering up as well in the future.
Yep. And Pierre, I totally agree with you. He was saying that some of these companies have been acquired. When he was talking about the immunotherapy, it was a company, I think he said, bought 25% of acquisition to combat cancer. I don't see the name of the company. He listed the company though, but he was talking about things like Pfizer, and a smaller company comes out, they'll just acquire them. And I agree, Pierre, that is what happens.
Right. Yep.
And that's also when you go to this private, and that's why we want to have a diversified offering inside of the IA platform. Some of this stuff, no one ever told us, Leon and I just happened to get into this industry, but we learned so much over the last 28 years investing but we still have friends that really just don't know this stuff. And it's just, we got tired of it because it's a game where the rich get richer and we just get left. And we're like, it's not going to happen. But then also you didn't have somebody that was talking plain English, that was just telling you about these stocks in a way that made you go, okay, I can digest that information. And then we started noticing our members are smart as I don't know what. Our members started listing stocks that we didn't even think about sometimes. And even Pierre, with your listing, I didn't even know about that process. I'm gonna look it up, but I didn't know before now. So we're having conversations like that inside of our membership platform, and it's helping members get together and have sidebar conversations and just kind of talk about where the opportunities lie. And Leon and I, when we got Popcom, we bought in at 55 cents a share, and now we're part of their second round, and we're locked in. So we're locked in at 55 cents a share, and whether the company wins or not, we're learning so much about how private equity works. We're then taking that information and returning it to you all. So we're really serving as you all's guinea pig, and we don't mind.
Yeah, I mean, we're going through the process of the private equity side ourselves first. We're learning a lot, and then, like as I said, we're going to be offering up that service again to IEA members. Because I mean, just think about getting in a Google or an Apple or Facebook before the IPO. Getting that stock at, like Brent said, we got in at Popcom 55 cents. Popcom may go out of business tomorrow. Who knows? They may be the next Google. Who knows? But either way, 55 cents we're in. We could benefit. We could not. But again, it's risk capital. So if we lose it, we'll still be able to eat. We'll still be able to go to the doctor. We're not going to lose our lives over it. So it's just another investment vehicle that a lot of people don't know about, or don't have the time to look up, that Brent and I are going to be offering up to people.
Yeah, and as the membership grows, and it's growing pretty fast now, we're going to start hitting some of these companies up, saying, look, we would love for your CEO to come speak to our platform and tell us, like, what do you do? Why do you do it? Because there isn't enough people flexing. We have a community of educated individuals who are ready to invest. Now, they may not be all high net worth. We do have those too inside the membership. Let me be very clear. There are a number of multimillionaires that follow Leon and I and are part of the IEA ecosystem. But at the same time, we realize there are a lot of people who are just getting started. Imagine being able to talk to the individuals who started these companies from a standpoint of, maybe it's not even the fact that you want to invest in them, but you realize, hey, I could take my company public too. Or you realize, like, you know what, I would love to go work for this company. And these are the conversations you normally just wouldn't have, but because we're leveraging really the size and the depth of the membership in the organization, we know what to bring to you all. And as much as we can, we're not bringing bull. We're going to read through people who are trying to just get over, and we're going to try to bring the best information possible to you all. We totally didn't get going down this road.
Yeah, right. I mean, we tried 20 minutes and we never stayed at 20 minutes.
So
all right, that's all I had. Yeah. So those are the 14 companies that we identified. We identified 29. These are the 19 or the 14, about half of the companies that possibly can benefit from this pandemic now and going forward.
Yeah, and I see some of the comments are coming in. You can't see them, Lee. And some of the people I know who are asking some of these questions, and the company was called Popcom, and the why Leon and I are doing this is really, it goes back to the fact that it is a lot of information to create wealth in this world, and it's a lot. No one that we saw, well, there weren't enough people. I'm not gonna say no one. I take that back. There weren't enough people bringing it to the masses in a way that it could be digested. And honestly, then it was another subgroup of people that were just lying. They're out there.
Bold-faced lying.
You want to tell them about it, Lee?
No, go ahead. I'm good. I mean, I just the whole Lambo thing, but now I'm good.
So some of these people you see saying, how I took $1,000 and made it this, or they're like, join us. Me and my new team are making $5,000 a month. Some of it's crap. I mean, and truthfully, some of those people, they really don't understand the market. Like, if you really start asking them questions about how it works, they'll fold. And if you ask us questions about, you can ask me or Leon questions about the market, we're not folding. We're not even close to it. And if we don't know, we're gonna say, Oh yeah, we're like, you can throw anything, but at the same time, if we don't know, we don't know, because no one knows everything about the market.
Yeah.
But we know that we're viable people to go to, who will tell you the truth, whether we either know or we don't know. But these people out here lying, and that's the reality. We're not going to allow it to happen. So, with that being said, that's the reason why we do it, to bring some honesty to the marketplace. And we have a paid membership site. So we want to make money during the process, but we're making money to help other people make money. That makes sense to us. So it's something I'm gonna go to sleep at night feeling great about every day, because people have already started investing along the lines of some of our suggestions. I'll put it that way. And they're in the membership, which shows us we either did a really good job or they're still looking for us.
Yeah, right.
And I would say it's the latter. So I mean, with that being said, that's the reason why we do it. I just got a direct message, and so that's it. So with that being said, we got to give them 2 stock picks, Leon.
Right. All right. So I'll go first. So I did this week. I did Darden Restaurants, stock symbol DRI. Today they closed at $81.56, and they were up 3.94%. And right now they're 36% off their high from, I think, earlier this year. So Darden's interesting. So Darden owns a lot of restaurants. A lot of them, So they own Olive Garden, Longhorn Steakhouse, Cheddar Scratch's Kitchen, Yard House, The Capitol Grill, Seasons 52, Bahama Breeze, and Eddie V's. So Darden Restaurants owns all those companies. Their 2-year profit growth, average over that 2 years, has been 17.75%. And their sales growth over the 2 years has been about 5.4%. So again, it's Darden Restaurants, DRI. Today closed at $81.56, 36% off its recent high.
All right, and up, you can see the 5-year chart. And one of the things I'll say in regards to choosing Darden is, if you look at where the hit comes, is right at February the 7th. And that thing takes about over a 50% hit. It's like 65-70% hit. And looking at the upward trend of this stock shows you that it was already on a course for success. But with the pandemic hitting, even if it were to recover at 50% of that space, or really 70% of the 100% place, about $150 a share, was it 125?
The high was, I think, 128.
Yeah, and so, honestly, February 7th, it was at 120. Let us show you what happened in the market, everybody. Just please bear with me for a second. February 7th, it's at 120 a share. But what is this? March the 20th, it's at $39 a share. Now, does anybody really think every restaurant is never recovering? I mean, really, it's an insane thought. And so that's what we're looking at when we make some of these picks. So that's Darden. The symbol on the New York Stock Exchange is DRI. And please be careful when you're buying these stocks. Sometimes there are symbols that are similar, but just make sure you pay attention to what the symbol actually is.
Actually read the name. Like, this is Darden, DRI. Yeah.
And look at the description if you can, because we've heard of people buying like one that may be DRL because they thought it was a lowercase L. And so, you just really want to pay attention when you're buying these stocks. All right, let me see. So mine is going to be Intel. I didn't know what to do. So I ended up picking Intel. And let me tell you, when we talked about the gaming industry, semiconductors as a whole, I love the semiconductor marketplace. Now, if you're talking about gaming, that plus semiconductor industry is a double win. Intel is in the process of acquiring one of the bigger gaming systems out there. Even if they don't, let me say this, even if they don't, I think it's a great buy. But considering it's a high probability they will, you absolutely need to give Intel some serious consideration. Them alongside like Qualcomm, and if you heard Qualcomm's story last time, I think it was like a $384 investment in 1998 would have been a $37,000 appreciated to 37,000 by 2000. That's like less than 2 years. It was
2 years, right?
So there was an anomaly, but I think right now what's happening again, if you look at the trend of what we're talking about, 5G is right now. And we don't know. We think we know, but we really don't know how 5G is truly going to affect technology. We just don't. And there's a lot of people who think they do, but I think it's going to be inconceivable. And with that being said, companies like Intel are poised to run. So that's why I chose Intel. They're trading.
A quick note on Brent's point. So, as Brent said, semiconductors are great. So semiconductors, so over the last 5, I think I did 5 year study. Over the last 5 years, so technology over the last 5 years has dominated the market. And a lot of us know that. Technology is the cream of the crop of the stock market. But inside tech, semiconductors is the #1 industry inside tech. So I don't have the exact number in front of me, but it's a ballpark. So over the last 5 years, tech is up about, I think it was like 90%. But semiconductors, which is Intel, AMD, Broadcom, et cetera, are up over 200, I think it was like 200, 230%. So semiconductors has doubled the return of the tech industry, which alone is dominating the market. So Brent's pick being within semis is great. Like my pick, I think 2 or 3 weeks ago was Broadcom, symbol AVGO. I picked them for the exact same reason I just mentioned, that semiconductors are the cream of the crop of technology. So you really can't go wrong. I mean, you can always go wrong, but generally you really can't go wrong if you pick semiconductors within side of tech, like Brent did.
Let me tell you guys how this thing works. The reason I even begin to look at Intel is because inside of the Investment Education group, Malcolm Jones made a comment about Intel in one of the posts, and I just forgot about them. I mean, honestly, it's just them, Microsoft, for whatever reason, they just left my brain. And they're great companies. And so after Malcolm actually made the post, I went back in and looked at Intel. I was like, oh my gosh, it's actually a really great company. And started looking at what they're poised to do in regards to getting into gaming. I was like, this is a great play. And there are people who are adding to the community. It's not just like every pick. Leon and I went to some dark center and just did research for years. Well, some of it is like we're noticing the comments and we're going to do research and we're qualifying it and then we're bringing it to you all. So we really are reading what you all are posting inside of the Investing Education framework, and you guys are making some great selections. And so as a result, this is information because of our member, Malcolm, that we're able to bring to you all. And with Jamia, inviting 38 people yesterday or today, that really shows what's about to come from this community. And I'm excited. I'm really excited because there's a whole international group that just wants to tell us about ADRs, and we haven't even started to talk about the ADRs. And so I'm excited.
We'll go down that road another time.
Yeah, that's the cliffhanger.
So my last point though is so talking about biotechs earlier with Moderna. So just to give you an example of the volatility in Moderna. So when they made that announcement, the stock shot up, right? Everyone was like, oh, they're going to be the first one with the vaccine. So they hit the high point on May 15th. So 2 weeks ago, 10 days, 2 weeks ago. Since then, they're down almost 40%. So Moderna, so anyone that jumped on that, oh, they got the cure, oh, this is the new big thing, yada yada yada. A lot of people have been burned by Moderna in the last 2 weeks. They're down almost 40% in 2 weeks, based on, again, that whole thing with the news that came out, the offering they did, how shady it was. Oh, I heard today that a lot of insiders that work there are selling a lot of shares too. So Moderna, and this is why I go back to the point that if you want to play the COVID vaccine game, look for an established pharmaceutical or biotech like Pfizer or Abbott Labs or Merck, who aren't relying on the vaccine for their future. It's just an add-on product that they can make some money off of, but it's not the end all be all to the business like a lot of these kind of fly by nights like Moderna.
Yeah. And also, when you want to look at Moderna, if you look at some of their subsidiaries like Valera and Elpidera, hope I'm saying that right, just kind of know what's happening with their subsidy companies. Because sometimes we think we're divesting in a company and we go buy their subsidy, and we don't even realize we're buying their subsidy company. So just pay attention when you decide to divest, that you don't accidentally invest back into the same company under a different name.
Right.
So yeah, with that being said, I see the numbers ticking up. Oh, it's Springbrook, it's Bowie, Howard on here, it's Largo, it's all kind of people. But thank you for really sticking with this. We're approaching 1,000 views across our platforms, and it's all been organic. It's all been because of you guys sharing this information. And inside of the Investing Education Academy group on Facebook, the information has been rich. So I've been enjoying it. Even you guys giving us the comments on the logo has been great. So it's a lot to come. Leon will keep branding stuff. I'll keep enjoying it. And with that being said, Lee, unless you got anything else.
Nah, I'm good. Another good one.
Anything that we missed, and I know the comments are still coming in. I see our numbers are actually really high. Just post it into the Facebook, Investing Education Academy Facebook group. Investment Education Academy Facebook group, and we will get to the comment as quickly as we can. And let's have a conversation on it, because I'm sure our members would like to chime in. So it doesn't have to end because we're stopping. It just can pick up inside of the group.
And anybody who's watching who's maybe not a member, just search, as Brent said, Investing Education Academy on Facebook, and you'll see the owl. The owl is pretty recognizable. You'll see the owl, and that's our group.
Yeah, pretty soon, if you have our app, when it comes, we can just send it out through the app. So it's gonna be a great app. So look for it. All right, everybody. Have a good day.
All right.